Every generation is convinced it's wiser than the one before, until it repeats the same downfall in a slightly different disguise. That's the quiet rhythm of financial history. We don't create new mistakes, we just rebrand the old ones. Each bubble, from tulip mania to tech booms, begins with the same confident phrase. This time, it's different. But it never is. The only real change is the story we tell ourselves while the illusion lasts. Back in the 1600s, tulips weren't simply flowers. They were status tokens, luxury collectibles, long before anyone dreamed of digital assets or blockchains. In 1637, a single bulb sold for 10 times a craftsman's annual salary. People traded futures contracts on petals. And when the music stopped, merchants, nobles, and farmers all went bankrupt over something they could have grown in their backyard. Then came the South Sea Company in 1720, the official sponsor of greed. The British government itself backed a corporation that promised infinite wealth through trade with South America, except it never traded anything. Everyone invested anyway. Politicians, aristocrats, even Isaac Newton, the man who could calculate planetary motion but couldn't predict human emotion. He lost most of his fortune in the crash, and famously said, "I can calculate the movement of the stars but not the madness of men." And the madness wasn't confined to Britain. That same year, across the Channel, France had its own delusion, the Mississippi bubble. A Scottish gambler named John Law convinced the French government to issue paper money and sell shares in a company that supposedly owned vast gold mines in Louisiana. It was a national fantasy built on colonial propaganda, the promise of endless wealth printed out of thin air. When confidence collapsed, both the company and the currency imploded, destroying France's early experiment with paper money and paving the way for decades of distrust. 2 countries, 1 year, same story. The moment speculation goes viral, borders stop mattering. Fast forward to the 1920s. The radio was the internet of its time. Stocks doubled, tripled, quadrupled. Banks loaned money to people who bought more stocks, which raised prices, which created collateral for more loans. It was self-reinforcing insanity disguised as prosperity. When the market crashed in 1929, it erased nearly half of America's industrial production in 3 years. That's what happens when leverage meets euphoria. When everyone borrows tomorrow's wealth to buy today's illusion. Bubbles are not about numbers, they're about belief. Every one of them begins with something real, a breakthrough, a new technology, a fresh frontier, and every one of them dies the same way. Not because the idea was wrong, but because the story was too good. That's the anatomy of a bubble. Something exciting, something misunderstood, and something over-leveraged. It's part psychology, part economics, and mostly theater. And here's the scary part. You're living through one right now. The only question is whether you'll see it before it bursts. To understand how, we need to talk about the pattern. The rhythm of mania that history repeats like a drumbeat every generation. Every bubble begins with innovation. It's the spark that makes greed look like vision. The tulip was a biological mutation. The South Sea Company was financial engineering. Innovation always gives speculation a moral alibi. Then comes liquidity. Easy money, low interest rates, credit expansion, or, in the 21st century, quantitative easing. The more accessible the cash, the faster belief spreads. And once prices start rising, you don't even need innovation anymore, just momentum. In the 1990s, the internet arrived and investors lost their minds in binary. Anything with "com" in the name doubled overnight. People quit jobs to day trade tech stocks. Venture capital poured gasoline on the mania. Analysts claimed profits didn't matter. Eyeballs did. By 2000, the Nasdaq had tripled. A year later, it lost 80% of its value. And here's the irony. The internet was revolutionary. It changed everything. Just not at the prices people paid for it. Then came the housing bubble, the masterpiece of financial illusion. Homeownership was sacred, risk was diversified, and everyone from Wall Street to your barber believed real estate could never fall. But underneath the optimism was a Rube Goldberg machine of debt. Mortgage-backed securities, credit default swaps, synthetic CDOSs, paper stacked on paper until no one knew what anything was worth. When it collapsed in 2008, global GDP shrank by $4 trillion. Banks were bailed out. Homeowners weren't. History's favorite trick repeated itself. Privatize the gains. Socialize the losses. Here's the uncomfortable truth. Bubbles aren't just markets losing control. They're power structures refusing to every time the system breaks. Those at the top write new rules to make sure it won't break for them next time. Central banks cut rates. Governments hand out bailouts. And everyone swears lessons were learned. But the only lesson the elite ever learn is that risk pays because someone else will always clean up the mess. And then came the bubble that wasn't supposed to be possible. Digital assets. Crypto started as rebellion, a decentralized alternative to the financial system that caused 2008. But as soon as money flooded in, it turned into the same old game. ICOs replaced IPOs. Tokens replaced tulips. The slogans were new. HODL diamond hands, number go up. But the psychology was identical. Then came the purest, speculative fever of all. NFTs. A JPG of a rock sold for $1.3 million. A pixelated ape sold for $3 million. Twitter avatars became investment portfolios. People weren't buying art, they were buying membership in a fantasy. Collectors called themselves hodlers, short for hold on for dear life. Forums filled with memes about diamond hands. The idea that selling was betrayal. Every bubble has its language. This was the dialect of digital faith. Then came the root, projects that vanished overnight. Insiders cashing out, leaving holders with worthless tokens. Floor prices collapsed. Trading volume fell by 90%. The NFT boom turned out to be the South Sea bubble written in code, a modern reminder that you can team at scarcity out of abundance. But here's the thing. The lesson isn't just that greed repeats, it's that power learns. After every crash, the system evolves to make the next one bigger, faster, and harder to escape. Today, bubbles don't need tulips or JPEs, the system itself is the bubble. Zero interest rate policies pumped cheap money into everything. Stocks, housing, private equity, even art. The Federal Reserve printed nearly $9 trillion after 2008. That liquidity had to go somewhere, and it didn't go to you. It went to assets, driving up prices that made the rich richer and made everyone else think they were rich too. Governments across the world kept the illusion alive with stimulus and credit. In 2021, U.S. household net worth jumped by $30 trillion, even as wages barely moved. Everyone felt wealthier, but it was paper wealth, dependent on near-zero interest rates and inflated valuations. When the Fed started tightening, the air hissed out fast. Stocks fell, housing slowed, crypto evaporated. For a brief moment, reality peeked through the cracks. And then we all went back to pretending again. The bubble isn't just in markets, it's in expectations. We've built a global economy that needs permanent optimism to function. Every pension fund, every startup, every government bond portfolio, all of it depends on growth that never stops. But growth can't go on forever. Nothing in nature compounds infinitely. Yet, that's the lie holding the financial system together. The same warning signs flash again. Corporate debt is at record highs. Tech valuations are back to pre-crash levels. Private equity is sitting on mountains of leveraged bets. The AI boom is echoing every bubble before it. A real technology wrapped in a trillion-dollar fantasy. History's telling us what comes next, but we're too busy buying call options to listen. So, can you spot the next bubble before it pops? Maybe. Look for 3 signs. First, when prices rise faster than comprehension. Second, when experts say you don't understand the new paradigm. And third, when your friends start getting rich doing nothing. That's when you're no longer investing. You're auditioning for a history book. The hard truth is that bubbles don't die because of math. They die when reality runs out of believers. If you want financial freedom, stop chasing the next mania. Train yourself to spot the rhythm, because the greatest bubble isn't in Bitcoin, real estate, or the latest tech craze. It is in believing that someone else will sound the alarm before it all collapses. History doesn't copy and paste itself, but it does echo. And if you can catch that echo, you already sense what's coming. If this shifted how you see things, make sure to subscribe. The past leaves clues, I'll help you uncover them.